This is not investment advice. This is a public information research framework. Dell's latest quarter looks like a hardware earnings beat on the surface. But the real question is not how many PCs Dell sold. The real question is whether the market is starting to reprice Dell as an AI infrastructure company. There is also a political headline layered on top. The Washington Post reported that disclosure forms showed President Trump's portfolio acquired Dell stock in February, with the largest purchase valued between $1 million and $5 million. The same report also noted a $7 billion Pentagon contract awarded to Dell's federal subsidiary. That does not automatically make the stock a buy, and it does not prove illegality. It is something more subtle. It turns Dell from an AI server story into an AI infrastructure, government procurement, and political headline story. Start with the numbers. Dell reported fiscal 2027 first quarter revenue of $43.8 billion, a record level. AI server revenue reached $16.1 billion in the quarter, up 757% year-over-year. AI server orders reached $24.4 billion, and AI backlog reached $51.3 billion. The company raised its fiscal 2027 AI server revenue outlook to $60 billion. Total fiscal 2027 revenue guidance moved to $165 to $169 billion. The message is simple. Dell is not just talking about AI. At the order, delivery, and revenue level, AI servers have become the strongest engine in the business. For market reaction, I am using regular session pricing. On May 28, 2026, Dell closed at $317.05, up 3.84% from the previous close of $305.32. After hours and media headline reactions were more dramatic, but I do not want to mix price timestamps. So what is the market really buying? It is not buying a PC company. It is buying the possibility that Dell becomes one of the main assembly lines for AI factories. Most people look at AI and only see NVIDIA. But NVIDIA chips do not magically appear inside data centers. They need racks, servers, networking, storage, cooling, power, procurement, deployment, and support. That is where Dell sits. If customers want a complete AI infrastructure stack instead of trying to assemble GPU systems themselves, Dell's value is not just hardware resale. It is integration, supply chain, enterprise relationships, and execution capacity. That is why Dell AI Factory and Power Rack matter. Customers are not just buying parts. They are buying a deployable AI factory that can fit procurement, support, service, and enterprise operations. But this is also where the risk begins. Exploding revenue does not automatically mean exploding profit quality. AI servers can become high revenue, low margin pass-through hardware. GPU, memory, networking, and cooling are expensive. If Dell is only packaging expensive NVIDIA systems, revenue can look spectacular while margins stay under pressure. So the real question is not whether Dell is strong this quarter. The real question is whether Dell can move from AI server vendor to AI infrastructure platform. Now add the Trump headline carefully. The Washington Post report has 3 parts: the disclosed Dell stock purchases, the Pentagon contract, and ethics experts raising appearance of conflict concerns. The White House and Trump Organization pushed back on the conflict framing, with the Trump Organization saying the holdings are managed by third-party institutions. For investors, this is not a fundamental moat. It is a narrative amplifier. It increases attention, controversy, and possibly policy-related volatility. For a stock, that can create narrative premium, but it also creates headline risk. Here is the framework. At the surface, Dell is an AI server growth story. One layer deeper, Dell is an integration node in the AI data center supply chain. With the Trump and Pentagon headlines, it also becomes a stock tied to AI capex. federal procurement, and political controversy. That is why it is interesting. Not because it is safe, because it is complex. Complexity can create mispricing, but it can also punish bad timing. The risks are clear. First, AI server margins may not be high enough. Second, demand may depend on a small number of very large customers. Third, supply chain constraints could make the $60 billion AI outlook harder to deliver. Fourth, the PC business is still cyclical. Fifth, political attention is not the same as durable fundamentals. My conclusion is that Dell is no longer just a traditional PC company. The market is starting to place it inside the AI infrastructure basket, but this is not a lazy bull story. The three metrics to watch are AI server revenue conversion, ISG margin recovery, and whether cash flow follows the scale of revenue. Thesis: if Dell converts the $60 billion AI server outlook into durable cash flow and margin improvement, the market can continue to revalue it from hardware vendor to AI infrastructure integrator. In validation, AI server growth slows, backlog conversion slips, ISG margin compresses, or management cuts fiscal 2027 guidance. Base rate: unknown. This AI infrastructure revenue scale has no stable historical sample for Dell. Alternate: this is a low-margin hardware pass-through boom. Revenue looks enormous, but profit quality and customer concentration fail to justify a higher multiple. That is the framework. Again, this is not investment advice.